Dear friends, welcome to the monthly market commentary. We live in extremely volatile world environment. Also, with the urge to focus on short-term performance, markets tend to react to near-term news flow in a more accentuated manner. These news flows can be driven by various factors, including geopolitical, domestic macro, and micro. Market can get too excited about these events when looked at it from a microscope. However, over the long term, markets are driven by earnings, cash flow, and the sustainability of these parameters. Even now, the expectation of changes in the US policies and the slow earnings growth environment has triggered anxiety in the markets. After peaking at the end of September 2024, markets have been in the correction mode. All indices, including large, mid, and small, all have corrected between 12 and 15%. This so far is the biggest correction in markets for some time now. We believe that this correction is due to a confluence of factors, both global and local. Over the last few months, there has been outflows of global funds from India. Over the last 18 months, we have witnessed one of the biggest outflows from the domestic markets. Between October 2021 and June 2022, foreign institutional investors sold around $33 billion. During this period, markets tanked about 16%. So far, FIIs have offloaded about $18 billion. Also, the relative strength of flows into Indian markets compared to other emerging markets have been weaker. Currently, US domiciled funds have been pulling money out from Indian markets following Trump's victory. This dollar carry trade reversal is visible across emerging markets. But India and China are witnessing bigger redemptions. However, domestic flows remain undeterred despite the big correction in the markets over the last 2 months. In fact, inflows into small cap hit a 18-month high. They have been defying market weakness. Inflows into mid caps also scaled to a new record high of 5,100 crores in December 2024. Overall, active mutual fund inflows continue to remain very robust, with monthly average of about 38,000 crores since May 2024. But it's important to note that a gradual shift is taking place from sectoral or thematic funds to a more broad-based funds. Inflows into sectoral or thematic funds have given a boost to many of those stocks. Since that liquidity has slowed down, we have seen weaker trend emerging in these pockets of the market. We believe the recent FII sell-off in India has actually been triggered by a multitude of factors, including global economic conditions. This world is navigating a complex macroeconomic environment with constantly changing interest rate projections, rising geopolitical tensions, and an uncertain and diverse global growth outlook. India isn't the only emerging market that has seen FII outflows since September end 2024. Since then, other emerging markets like Indonesia, Taiwan, Brazil, South Africa, Thailand, and many others have also seen continued outflows. Another important aspect has been about US dollar strengthening. US dollar has seen broad-based strengthening across markets. While Indian currency has depreciated about 3% in the last 4 months, other major currencies have depreciated anywhere between 5 and 10%. Lastly, slowdown in corporate earnings growth has also been one of the most important reasons for the recent sell-off in the markets. Let us now look at what can be the outlook on FII flows. Alternatively, are markets returns linked to macro or micro? Many markets have delivered strong long-period GDP growth, but with limited market returns, while Indian market has been different. India's returns have coincided with a strong GDP growth rate. This is a coincidence. India's returns have performed more in response to a strong corporate performance. There can be a lead lag effect though. As global volatility increases, we believe we are back to the basics of investing. Returns in markets are a function of not only growth, but value-adding growth. The growth should be backed by superior return on capital employed, and the ROCE must be higher than the cost of capital. Companies with superior ROCE and their ability to deliver these over long period are more likely to post superior returns over the long term. This can apply to countries as well. India scores relatively better than its peers on this count. On the ROCE curve, India is superior to many countries, as the structure of India's growth is not as much commodities, but more value-adding manufacturing or services. These businesses have relatively superior cash flows and return ratios. Also, India has been able to deliver a superior returns over a long period due to its entrepreneurial culture. Many entrepreneurs are frugal, adaptive, focused, and have demonstrated their ability to fight the changing environment and deliver results. Let us now look at how Q3 FY25 business performances has been. While the result season is in progress, companies primarily from IT services and lending financial services have declared their quarterly numbers. In the IT sector, results have largely met consensus expectations. Commentary across companies varied significantly, resulting in notable differences in the stock price performance. Many IT firms are signaling a potential pickup in the US demand by FY26. While the pickup is expected, it is off the low base of FY25, and most IT companies would still deliver single-digit US dollar growth. Current Indian currency depreciation should help margins of IT companies in the short term. However, over medium term, these benefits have been passed on to the clients in the past. A key takeaway from the results is the arrest of declining manpower strength, and we should gradually see it inching up. For banks and non-banking financial services, performance has been broadly in line with or slightly below the consensus estimates. However, growing concerns about slower credit growth have emerged. On the discretionary consumption front, businesses so far have reported continued growth. Quick commerce though has reported strong growth, but increased competitive intensity has resulted in impact on margins. Hotels or aviation companies reported decent set of numbers. Staples companies have reported a continued slow business. While the government capex was slow in the quarter gone by, cable and wire companies that have reported results so far have reported very strong set of numbers. In an environment of a slow earnings growth, it is important to focus on bottom-up ideation rather than the top-down approach. We believe select businesses in discretionary consumption, manufacturing, and pharmaceutical should do well. Consumption could continue to benefit from improved hiring by IT companies, moderate inflation, and continued income growth. Manufacturing sector is expected to do well, driven by redrawing of global supply lines, focus on import substitution, and rebuilding or creating infrastructure in India and globally as well. The businesses operating in electronic manufacturing, energy transition, circular economy, and semiconductors are expected to do well. Pharmaceutical is another very interesting area. The focus here is on entire ecosystem of India branded, US generic, CDMO, hospitals, consumables, and others. At ASK, we have a sharp focus on high quality and growth oriented businesses. Businesses that are operating in manufacturing, discretionary consumption, and pharmaceutical, while being underweight on banks. We have focused on businesses that have execution prowess and ability to increase market share across varied business environment. Also, companies with value-adding profit growth should continue to command a valuation premium. The focus has to be on growth rather than pure cigar butts. Thank you and happy investing.